a pension manager, I mentioned this in the first segment. He said he's got concerns, and you mentioned them to me last week, because he's seeing more and more people just chuck in the towel saying, I can't take it anymore. I can't save. 8% mortgages are just too steep. Why save? Inflation is running at, say, over 20% for the things that we use every day. Why save? Well, you know what? I can't save. The all-out war on the middle-class consumer is taking its toll, and it's starting to come through in their behavior. What are they to do when everyday life gets this expensive? Now, my next guest says he actually likes what he's seeing. He's a glutton for punishment. Please welcome to the show the Venerable Keith Fitz-Gerald. Keith, you actually like what you're seeing. I want to hear about this.
Well, we've got to be careful with this because I don't like it all the way. Let's talk a couple things, right? So a change in consumer behavior, that's really indicative of systematic key turning points in the marketplace. So, we can debate till the cows come home. Is this good? Is this bad? Is it ugly? What is this? What we don't know is that the herd is usually wrong. And what we do know is that the markets tend to respond to that after they reach a tipping point. So to me, this change in psychology, maybe it's YOLO, I don't know. But what I do see is that customers must spend. That's the part that these economically illiterate dolts inside the Beltway don't seem to understand. This isn't the discretionary items. This is why consumer stocks are, for example, getting pummeled and tech continues to take off. They're going for things that they cannot live without. So that to me is a customer that's not YOLOing. That's a customer that's just trying to survive.
Yeah, I gave you that, but I'm going to raise you one. So I want to hear what your point is against this. We had Kroger come out about 4 weeks ago and revise down their sales for the second half of this year. I guess it would probably be more than four weeks ago, but still, their CFO came out and said he's going to. Now they don't sell a lot of clothing and technology, and I mean when Kroger, which is pretty much food if you ask me, they're starting to lower their forecast. That's not a good sign.
Okay, again, even here, Scott, I would respectfully push back. So, yes, the consumer is changing their habits. Yes, the consumer is buying differently. But what that says to me, Scott, is management didn't properly anticipate the shift. So the company's going to have to pivot and buy differently, perhaps stock differently, perhaps rethink their inventory, perhaps think about what they've got on their shelves, perhaps think about how they actually do things. Because if you take another company at the other end of the spectrum, for example, McDonald's, which brilliantly introduced an app. They've got 52 million consumers who can't get enough of the company. They're acquiring names, they're building market share, and they're attracting all the customers who are going down market from higher restaurants. Why can't grocery stores do the same thing?
Yeah, I think they probably try, but that's a good point, and you bring that up, and it could be management's fault for not seeing what was coming around the corner. That's also it is happening a little bit at Walmart, and the Costco CFO said something similar there. But it's going to be interesting to see how this shakes out, Keith. I mean, I know you're usually an upbeat person and you don't really get too political, but from your point of view, how healthy is this economy? Do you have any concerns about if your grandmother died and gave you $5 million in the inheritance? Gosh, that'd be a great thing, but not that she dies. But if you got the money, would you say plow it all in right now, or are you going to hold something back? 5%, a 5% 10-year. What are you doing with it?
Well, I think that's an interesting question. And number one, if I change my opinion based on the amount of money, I wouldn't be very good at my job. So I would stick, whether it's $5, $5 million, $500 million, I would stick to the principles that are tested and true. Number one, I would look to buy the strongest companies only, best names, top of the heap, period. And I would go into them over a matter of time. That allows me to harness the volatility other people fear. Two, I would look for companies with fortress-like balance sheets and the willingness to protect margins. I don't care about the marginal players. What I care about is the companies that are putting numbers up. And we've seen some good ones here recently. We've seen McDonald's do it. We've seen Pepsi do it. We've seen JP Morgan do it. We've seen, Apple's coming up. I expect them to do it this week. So there's still plenty of opportunity. And third, and finally, I would take a look at the psychology of the marketplace. If you're learning to play poker, the worst thing you can do is actually bet on the hand. What you want to do is look around the table and see what everybody else thinks, then make your bet. That's what I would do if I got an inheritance like that.
Okay, that's great. And I'm gonna turn it around one more time, because your last comment just reminded me. What wouldn't you do? What are some things that you should steer clear of? I think that's also a good idea.
We talk with our clients about that all the time. The worst thing you can do is place all your money on the table at once and take a hot flyer just because your crazy uncle and everybody's got one of those. Your crazy uncle says so, or you heard about a stock tip at a barbecue. People ask me all the time, Scott, about what's the next hot stock? That's the wrong question, especially now. The question you want to be thinking about is which stocks do I want to own in 5 or 10 years, and which stocks are going to cause me to kick myself in the rumpus if I don't. Those are the stocks that are going to be there when you need them. Investing is not about goals or other people's plans. It's about meeting your own expectations and your own needs.
And it's easy to get upset in the short term, and a lot of people want to bail and stuff like that. But if you would have bought the high in the stock market every year since 1929, I don't know what the word would be, but you'd be something well north of a billionaire, because it's done so well over time that staying in the market, being invested like that, I get it. But it does get emotionally difficult, right? You got about 10 seconds.
It's tough. It's nerve-wracking, but you need to hold your nose and be in anyway, because that's what history shows beyond any shadow of a doubt is the best course of action if you can afford to do it.
Yeah, because you'll get out, but the problem is that nobody ever gets back in at the right time. And so I've seen it happen. We used to manage money, and every time the market would start to get weak, a lot of folks would bail, but they would never get back in, miss it on the way back up, and it was always bad on the way out and bad on the way in. All right, appreciate it. Thank you very much, Keith. That's great stuff. Keith Fitz-Gerald coming to us from Seattle. So we've had Texas, now we have Seattle.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.